In September 2008, the American financial system stood on the edge of complete collapse. Lehman Brothers, one of the oldest and most prestigious investment banks on Wall Street, had just filed for the largest bankruptcy in United States history. Credit markets froze, stock markets plunged. Fear gripped every corner of the global economy. The Federal Reserve, America's central bank, faced an unprecedented challenge. Traditional monetary policy tools were failing. Interest rates had already been slashed to near zero, yet the economy continued its terrifying descent. Something radical was needed. What emerged from this crisis was a monetary experiment unlike anything the United States had ever attempted. It was called quantitative easing, and it would fundamentally reshape how we think about central banking, money creation, and economic intervention. Today, we are going to explore this extraordinary chapter in American financial history. We will examine what quantitative easing actually means, how it was implemented across multiple rounds, its effects on the economy, the controversies it sparked, and its lasting legacy on monetary policy. To understand quantitative easing, we must first understand the depth of the crisis that demanded it. The 2008 financial crisis originated in the American housing market. Years of reckless lending, complex financial instruments, and inadequate regulation had created a massive bubble. When housing prices began falling in 2007, the entire structure began to crumble. Banks had loaded their balance sheets with mortgage-backed securities that were now worth a fraction of their original value. Trust between financial institutions evaporated. Banks stopped lending to each other, and more importantly, they stopped lending to businesses and consumers. The Federal Reserve, led by Chairman Ben Bernanke, responded initially with conventional tools. The federal funds rate, which is the interest rate banks charge each other for overnight loans, was cut aggressively. By December 2008, it had reached effectively zero, in a range between 0 and 0.25%. But here was the problem. You cannot cut interest rates below zero. This situation is known as the zero lower bound, and it represented a dead end for traditional monetary policy. The economy was still collapsing, unemployment was soaring, and the Fed had seemingly run out of ammunition, or had it. Quantitative easing, often abbreviated as QE, represents an unconventional monetary policy tool used when traditional interest rate adjustments are no longer effective. Here is how it works in simple terms. The Federal Reserve creates new money electronically. This is not physical printing of dollar bills, but rather digital entries in bank accounts. The Fed then uses this newly created money to purchase financial assets, primarily government bonds and mortgage-backed securities, from banks and other financial institutions. When the Fed buys these assets, two important things happen. First, the sellers now have cash instead of bonds. This increases the money supply in the economy. Second, the increased demand for bonds pushes their prices up, which mathematically means their yields, or interest rates, go down. The goal is to lower long-term interest rates across the economy. When borrowing becomes cheaper, the theory goes, businesses will invest more, consumers will spend more, and economic activity will increase. Additionally, lower yields on safe assets like government bonds push investors toward riskier investments like stocks and corporate bonds, potentially stimulating business growth. Ben Bernanke, who had studied the Great Depression extensively as an academic economist, believed that insufficient monetary response had worsened that earlier crisis. He was determined not to repeat that mistake. The first round of quantitative easing, known as QE1, began in November 2008 and expanded significantly in March 2009. The Federal Reserve announced it would purchase up to $1.25 trillion in mortgage-backed securities, up to $200 billion in debt issued by government-sponsored enterprises like Fannie Mae and Freddie Mac, and up to $300 billion in longer-term Treasury securities. These were staggering numbers. Never before had the Federal Reserve intervened in financial markets on such a massive scale. The immediate goal of QE1 was to stabilize the mortgage market and prevent a complete collapse of housing finance. By purchasing mortgage-backed securities, the Fed provided a buyer of last resort, restoring some confidence to a market that had completely seized up. The effects were noticeable. Mortgage rates declined, making home purchases more affordable. Credit markets began to thaw. The stock market, which had hit its crisis low in March 2009, began a recovery that would continue for years. By the time QE1 concluded in March 2010, The Federal Reserve had added approximately $1.75 trillion in assets to its balance sheet. Despite the massive intervention of QE1, the economic recovery remained disappointingly weak. Unemployment stayed stubbornly high, hovering near 10%. Growth was anemic. In November 2010, the Federal Reserve announced QE2, a second round of asset purchases. This time, the Fed committed to buying $600 billion in longer-term Treasury securities over 8 months. The focus of QE2 was slightly different from QE1. Rather than stabilizing specific markets, QE2 aimed to further reduce long-term interest rates and combat concerns about deflation, a dangerous situation where falling prices discourage spending and investment. Following QE2, the Fed implemented what became known as Operation Twist in September 2011. This program involved selling shorter-term Treasury securities and using the proceeds to buy longer-term securities. The goal was to flatten the yield curve, reducing long-term rates without expanding the overall balance sheet. Operation Twist was named after a similar program implemented in 1961, which itself was named after the popular dance craze of that era. By 2012, the economy was growing but still not producing enough jobs. The unemployment rate remained above 8%, well above what economists considered healthy. In September 2012, the Federal Reserve announced QE3, which represented a significant evolution in approach. Unlike the previous rounds, QE3 was open-ended. The Fed committed to purchasing $40 billion per month in mortgage-backed securities, with no predetermined end date. Chairman Bernanke stated that purchases would continue until the labor market improved substantially. In December 2012, the program expanded to include $45 billion per month in Treasury securities. This approach tied monetary policy directly to employment outcomes, signaling the Fed's commitment to supporting the economy for as long as necessary. At its peak, the Federal Reserve was injecting $85 billion per month into financial markets. In May 2013, Ben Bernanke suggested that the Fed might begin reducing its asset purchases if economic conditions continued improving. This announcement triggered what became known as the taper tantrum. Bond yields spiked dramatically. Stock markets around the world sold off. The reaction demonstrated just how dependent financial markets had become on Federal Reserve support. The actual tapering began in December 2013, with the Fed gradually reducing its monthly purchases. By October 2014, QE3 officially ended. The Federal Reserve's balance sheet had ballooned from around $900 billion before the crisis to approximately $4.5 trillion. The next phase involved normalizing monetary policy. In December 2015, the Fed raised interest rates for the first time since 2006. Gradual rate increases followed over subsequent years. The Fed also began slowly reducing its balance sheet in 2017, allowing bonds to mature without reinvesting the proceeds. Just as the Federal Reserve appeared to be successfully unwinding its crisis-era policies, a new crisis emerged. The COVID-19 pandemic struck in early 2020, triggering economic shutdowns worldwide. The Fed responded with overwhelming force, cutting interest rates back to zero and launching unlimited quantitative easing. The balance sheet, which had been reduced to around $3.8 trillion, exploded to nearly $9 trillion by 2022. This demonstrated that QE had transformed from an emergency measure into a standard tool in the Federal Reserve arsenal. Quantitative easing remains controversial. Critics argue it inflated asset prices, primarily benefiting the wealthy who own stocks and real estate. They worry about long-term consequences, including potential inflation and market distortions. Supporters contend that QE prevented a second Great Depression and supported millions of jobs during recovery. What is undeniable is that post-2008 monetary policy fundamentally changed central banking. The Federal Reserve demonstrated its willingness to intervene in unprecedented ways during crises. Whether this represents progress or dangerous precedent will be debated by economists and historians for generations to come. The experiment that began in desperation during 2008 has become a permanent feature of modern monetary policy, reshaping the relationship between central banks, financial markets, and the broader economy.